Well, folks, welcome. Mark and I are excited about our new class, which is split strike calendars. And we have never done a class on split strike calendar. We've done plenty on calendar. And I think this is something really over the last year, would you say, Mark?
Yeah, probably the last 6 months, really.
Yeah, last 6 months. And I think a lot of strategies, folks, just like a lot of different inventions or whatever people come up with, are based on necessity, right? Hey,
you bet.
How can we tweak a butterfly? How can we tweak a calendar to work better in the market? And so I didn't know what to call this thing.
Yeah, I asked my students, and one of them came up with that. I liked it. So
great idea. Yeah. So let's get into this a little bit. And this is for educational purposes today. So I'll just say, just to get it out of the way, class details. The start date for this 3-week class will be a week from Thursday, March 18. And class times will be 1 Central. All classes will be recorded. Class duration 2 times weekly. We'll go for 3 weeks. Teachers will be Mark and myself. Be $297. And what we will cover in class, I'll get to that in a second. I just want to get at, what we'll give, Mark and I will go over a little, we'll talk about it a little bit, and then we'll go in and give you a few examples on how we would, at least the setup. Okay, we want to give you. So Mark, what would you, someone came up to you and said, Mark, what the heck is a split strike calendar? How might you define it?
Well, to me, it's a trade that gives you a little more room on one side than the other. And it's long vega. And just basically selling 2 strikes, not the same one, but close to each other. Whereas in a calendar, it's the same one in 2 different expirations.
Yeah, and if we had to contrast it, like as Mark said, versus calendars, calendar is a mixed month spread. You're buying your a further out duration, selling it closer in, and usually the same strike. If you're doing it at the money, you're more non-directional. You'll do it at the money. If you're more bullish, the strike would be above where the market's trading at. If you're more bearish, the strike would be below where it's trading at. And so,
right.
Again, this is the type of trade, folks, where we can, I was thinking about this. It really can fit all the time because, when you think about overall, I was thinking about this, Mark, what's a typical market situation? I put here relevance in the current market or in typical markets, but a typical market, folks. So no, we're not talking diagonals. John, we were struggling with that word diagonal. So no diagonals. You could say maybe it would look like a diagonal, but we want to differentiate it from diagonals because usually when people think of diagonals, they're thinking kind of like a covered right substitute. Like, hey, buying a, maybe in the money call further out and then selling a near term out of the money call against it. Yes, you could call it diagonal, but we think it'll be more helpful with the split strike. But what I was thinking about, Mark, and give me your 2 cents on this, is that, folks, let me ask you a question. Usually, not on a day like today, but usually is the market more on the upside, a little more grinding, slower going up? With the exception being, when we've been down a bit, right? And then we're recovering. But would you say overall, folks, if you look at the upside of the market over the last 5-6 years, is the upside go up as fast as it goes down generally? Yes or no? No, right? And so the upside has maybe a different feel. I'm talking overall, these days, but when you say these days, Petru's saying, if we're down 5% in the market, down 125 points, like we were a week ago, then it's more normal to bounce back. It's not going to bounce back 5 points. It'll bounce back 100 points. But I'm talking about generally 95% of the time, market's moving up slower than it's going down. And I think this type of trade allows you to tweak a calendar to get 30 to 80% less risk on the downside, but having plenty of room on the upside. Would you word it like that, Mark, or maybe a little different?
That makes sense.
Yeah. So we're excited about this, folks, because it gives, if you've had calendars on when the market goes down 3 to 5%, doesn't happen that much, 3 to 5%, but it can be a pickle managing any type of trade on the downside. The downside, things go down, market goes down faster, and execution can be stinky. So what I think we'll do is, without further ado, Mark, you want to start? Maybe I'll have Mark go over an example of just to show you what they look like and talk about it. We won't get into adjustments today or anything, but we just want to kind of put this visual in front of you. What do we mean by split strike? Maybe I'll have Mark go over an example, then I'll go over one. Then if you have any general questions, we'll do that.
All right. Here,
and then I'll go over one.
Okay. So, technically speaking, is it a diagonal? Yes, technically, because you're not buying and selling the same strikes. But we wanted, as Dan said, to differentiate between a diagonal where you have a deep into money long, like an 80 delta, further out in time, and you sell calls against it in the near term, sort of like what we call a synthetic covered right. But instead, this is a trade that is very calendar-like. I mean, and we'll get into it in the class. You can put them at different widths and the reason why and that type of thing. But here's just a very simple example. This is a put diagonal. So you can see in this what we've done. We still use many times similar time frames as calendars too. In this case, what are we, like 10 days out, I believe. And what you do if you do the put diagonal is you buy the further up put, the deeper in the money put, however you want to put it. Somewhere around the money is what we're doing, although we'll be talking about why would I not do around the money. That'll all be part of the course also. But this is the basic one, right around the money, buying the 3,900, and then you sell a put right below it. So the long that you own is of course in the money before the short that you sold. So there is no margin. It's just whatever this trade cost you. So if you look at here, this trade would cost you $5.10, a little over $500, whatever. If you get filled at the mid. Now, why would I do it? Well, it gives me a lot more room on the downside, doesn't it? Whereas if I just did a calendar, it's very equal on each side. Well, this one gives me much more room on the downside. What do I pay for that? Well, I pay for that in the fact that I don't have as much room on the upside. The upside, I'll probably be wanting to adjust the trade, fix the trade a lot sooner. Now, conversely, if you wanted more room on the upside, you'd use calls. And with that one, the lower of the two would be in the money, or deeper in the money. So you'd pick that as your long and then sell the out of the money. So this is what this would look like. And as you can see, I have a lot more room on the upside now that I've done that. And that's the basic idea that we're talking about. And we'll get into, the wins of volatility, when to do this, how to adjust them, when to make them enter out or enter near the money or further out, and all those type of things that come up, and how this, of course, to fit this into your portfolio in general. So anyway, that's my basic example. Dan, if you want to show them something else.
Yeah. And here's another, folks, maybe with SPX at 3,900, maybe we start the short at 3,930. And our long at 3,940. And so you can see there here's the current underlying 3,901. We're buying one we're buying one April 23, 39.40, and we're selling one April 16, 39.30. And so that's something that interesting. There's another way we'll talk about it during the class that, and again, you're just very, very short delta, just a little short one delta, but you can see on the downside, very little risk, right? Here's the downside, and you can see where the P&L is, very little risk. And on the upside, if we go up, what's nice is the tent opens up, right? And you have nice room there. So we're going to go, we've been trading a lot of these. And, again, I think this is a very powerful way to trade calendars. And we're going to focus on this for 3 weeks. So we invite you to join. I mean, I think this will be a great help to you. We'll be putting on, in class, we'll cover complete risk management of this, what to do if it goes down or up. We'll be using live trade examples in every class. So it should be a great opportunity for you to really expand on this calendar strategy and learn it. Let me see. It says 2 new questions. Guy Brush says, so Dan, do you plan for some upside move by April? Not at all. I don't. So the fact that if you're more saying that I have more room on the upside, no, that's just because we have less risk on the downside. We're just saying if it goes up with the short delta, we're just how we're tweaking the trade. But Mark and I have no idea, just like you guys, we don't know where the market's going from day to day.
We're not direction pickers, are we, Dan?
Yeah, we are not direction pickers. We try to put on good high probability type trades the way we trade them, and our focus is more on the risk management. Will I be incorporating double diagonals during this class? No, the class is on split strike calendars. Even though you can call them diagonals, this is more that calendar focus. And really, we've just expanded on the way we trade calendars. What's the advantage of using farther out calls? Well, that's just what a calendar is, a mixed month trade. And your long is further out than your short. And the advantage, I mean, obviously, it gets into volatility levels and trading these. As you get mixed month trades, you're going to be a little more volatility sensitive, which we'll talk about. But that's what you do in calendars, is you're trading mixed months. On RUT, they have now Monday and Wednesday options. Do you recommend them? I mean, they're fine as long as you're in a liquid vehicle. I don't have a problem trading Monday or Wednesday options if you're in a liquid vehicle. And RUT, I mean, it's a pretty liquid vehicle. So anyways, so folks, we just wanted to give a little bit of an intro to this split strike calendar class. Again, first time we've ever taught this. This is just something from trading calendars for many years. This kind of the next progression that we thought, and a lot of it is just to control the risk. And so I think this will be an exciting addition for calendar traders. Is this more suited for SPX or RUT, Mark? What would you say on that?
I think SPX is what I mainly do, but I don't see why you couldn't do it in RUT.
Yeah, and I mainly do SPX also, but yeah, RUT you can do. And as far as targets, stops, adjustments,
that's a class thing.
Yeah, we will go over risk management till the cows come home in the class. And again, every class will have a live trade so we can follow it through and practice, right? So we'll have 6 different practice trades so you can get better at it. So anyways, folks, thank you for popping in. Oh, how long we're usually in these trades? It depends on the duration. Brendan, we won't be in these trades that long, maybe 25 to 30% of the duration, but we'll go over that more. Petru says, how do we trade these days in the market? How do you guys trade these days in the markets when SPX moves 120 points in a day? First of all, always perspective, right? Right? How many people think SPX moves 120 points every day? Yes or no? Yes or no? I know Petru doesn't mean that, but please say no. No, it's very rare, but it happens. And I think, again, that's why with this split strike calendar, this is a way to mitigate the risk, right? And the way the market trades, the different speed levels on the upside and downside, the purpose of this is to handle more volatility in the market. So we're excited about it. We will see you a week from Thursday. Mark, any final words of wisdom from the?
No, there's a lot to go over here. I think it's another tool you're going to want in your tool chest.
Yeah. So thanks, everybody. And we will see you soon. Appreciate it. Thanks. Thanks, Mark.